A problem many investors face is that they struggle to consistently find really great businesses to analyze and then invest their money in. And the reason why they struggle to find them is because there is just so many businesses out there that you cannot possibly analyze all of them. And in fact, if you're going to be analyzing them in depth, which you should be before you make any investment, then you're only going to be able to analyze a few stocks every month. So in this video, I'm going to explain to you how I personally find great businesses consistently and how I sort of filter through and pick which ones I'm going to be focusing my time on, because everyone's time is limited and we also want to be making sure that we spend as much time as possible analyzing businesses that do have the potential to be great investments. So if you do enjoy the video, make sure you leave a like, but let's get straight into it. So there's really two ways that you can go about this. There's the manual searching way, which is exactly what it sounds like. You're going to be manually looking through businesses, and I'll explain sort of how I do that. And the other way is that you can use a stock screener, which is some kind of software program, usually online, where you can pick certain criteria and sort through stocks and find stocks that way. And I'm going to show you exactly how I look and find businesses using both methods, because I do use both methods from time to time. So let's start with manually. How do I manually find stocks, and what are the ways that I filter through stocks in order to get the maximum amount of value out of my time when researching businesses? So this method will work really well if you know a few industries that you know really well. So if there's a couple of areas that you've invested in before maybe, or maybe it's an industry that you've worked in before, or you just understand because maybe you're a consumer in that industry, then this is going to work great. So what I would do is I would just start off by picking an industry, and let's say we're going to look at restaurants. So what I would do is I would Google list of US publicly traded restaurant companies. And this will instantly give you a list of 50 to 100 stocks. So you've instantly eliminated everything out of your field of vision for now, and you've got 50 to 100 stocks which you are capable of analyzing. If you wanted to go completely in depth into each one, you would be capable of doing it. Now, of course, you don't have the time to go through 50 to 100, and if you did have the time, you would be able to rank them. But we don't have the time, so we need to quickly filter through these. So what's the next step? The very first thing that I'm looking at is earnings and cash flow. So of course you would know that cash flow is how we're going to get paid as investors. It's what money we're going to get back. And that cash flow is either going to be kept in the business to grow the business, or to buy back stock, or it's going to be paid out to us as a dividend. So looking at those core profitability and cash flow numbers is going to give us an indication straight away as whether or not this company is worth looking at. So the first thing I would do is I would pull up a website such as quickfs.net, and then I would look through and I would see if their earnings per share and free cash flow numbers. I'd look at those numbers over the past 10 years, and if first of all, if they don't have 10 years of data for those numbers, I'm not interested at all. We're looking at companies that have a long track record of profitability. So if they don't have 10 years of data, then I'm not interested. And the second type of stock that I'm not interested in is stocks that aren't profitable consistently through that 10-year period. We want them to be profitable every year. We want them to be cash flow positive in most years. Sometimes they have a massive investment that they need to make, and that can be okay if we look into it. But for the most part, we want to know that they're profitable in every year throughout that period. And once we've done that, we've already crossed off a lot of the businesses on that 50 to 100 list. And then we will continue to look at the earnings per share and the free cash flow, and we'll see if it's growing over time. Because not only do we want to see that they are profitable, we don't want it to be all over the place. We don't want it to be up here, down here, over here. We want it to be a consistent growth upward so that we can predictably work out where it's going to go in the future, and therefore how much cash we're going to get back in the future. So that's another one. And again, this is going to cross off a ton of those businesses on the 50 to 100 list. And we will already have a fairly short list of restaurant businesses that are profitable, they have 10 years of data, they're consistent over those 10 years, and their earnings is growing over those 10 years. The next thing I generally look at when I'm doing this process is I look at debt. Now, debt I'm not too strict on debt because it depends on the type of business and all these other things, and it generally comes down to sort of a qualitative analysis of it by looking at specific companies. But on the surface level of debt, I'm just looking to make sure they don't have an outrageous amount. So I want to see that equity is bigger than debt consistently. So that means that they have a debt to equity ratio that's below 1. And in fact, I usually look for one that's below 0.5. And I'm also looking to see that over their short-term assets and debt, I want to make sure that they aren't consistently operating with lots of short-term debt relative to their short-term cash flows. We want to make sure that the short-term assets that they have are going to be able to cover their short-term debt obligations. And of course, if any of them don't meet those criteria, those basic top-level debt criterias, I cross them off and we move on. The next thing I look at is equity. Now, there's a couple of things I'm looking for here with equity. First of all, I'm looking for a lot of equity relative to their debt, as we just spoke about. And we're looking for equity to be consistently growing over time so that they're consistently bringing in money, investing it, and growing that equity, and that it's growing at a decent rate, that it's not too slow over the long term. And that means that they're going to be creating shareholder value for us over the long term. And from that fairly quick exercise, I mean, this takes less than 15 minutes, you would have a very short list of restaurant businesses that you can go ahead and start analyzing. And you just pick one and you start going through, well, I would start going through my entire criteria for that stock. And if you want to hear my entire criteria, I have a ton of videos talking about it on my channel, so go check it out if you're interested, and hit subscribe if you're new around here and you want to see more videos like that. But essentially, I would just go through one by one and cross them off if they don't meet that criteria. And generally speaking, most of those stocks won't meet your criteria, and you'll be able to cross them off quicker than you think. And every now and then you will find one that meets all of your criteria, and that'll be one that you look at in depth for the next couple of weeks or so. And there's a famous quote from Peter Lynch, and he says that the best investors are the ones that turn over the most stones. So just by looking at as many businesses as possible, you're likely going to find those hidden gems that are going to be the best businesses that you want to go ahead and study further, and then work out what price you want to pay for them, and then make those investments. So that sort of describes how I go about my manually finding stocks, and I do that for the most part in my personal research. However, every now and then I do use stock screeners to get some fresh ideas and just to quickly give me a quick list of businesses. And maybe it's because they're in industries that I haven't yet studied, but I might be interested in studying in. So that's why I would go ahead and find a stock screener. Now, there is a ton of different stock screeners out there, but generally speaking, most of the free ones aren't that good, which is why I don't really use stock screeners, because I don't want to pay for a service, and I think I can do a fairly good job myself. But there is a couple of fairly good ones out there. For US stocks, you can use FinViz, you can use Zacks. Both of those are very good in terms of looking at fundamentals and filtering businesses by fundamentals. For Australia, I had a harder time finding great ones, but you can use the free one from Morningstar. There is a Yahoo Finance one, investing.com has one, but what I found was none of these were as comprehensive as the US ones that I found from FinViz and from Zacks. Now, I would pretty much do the exact same process as I did with my manual searching, but I would do it in the screener. So you would start by looking at profitability. You're looking at earnings or free cash flow growth above 8 or 10% over the past 10 years. And then you move on to debt. Does it have, a debt to equity ratio below 1? They have at least a current ratio of above 1. You're just looking at these basic things. Is equity growing over time? Has the company been around for more than 20 or 30 years? So they have a ton of data available. You can look at IPO date in FinViz. You can look at that, and you can make it so that you only find companies that have been public for at least 30 years. So you've got tons of data. But generally the process is very much the same. The only reason I sort of stray away from stock screeners is because when it comes to the free ones, there's a couple of things. Some of them don't have up-to-date data. Some of them don't have all of the data that you would need to look at these businesses. And the other thing is that they don't have all of the businesses out there. If you just Google search an industry, you can find a complete list of all of the publicly traded companies for that industry, and you can be confident that that's going to be the complete list, compared to some kind of free software where you don't really know if you're missing particular businesses that could in fact be really great investments. I also sometimes like to just look at that list. So when we going back to the manual, when we just search for restaurant businesses and we find that 50 to 100 list, if you use a stock screener, it's going to eliminate anything that doesn't meet your criteria. And of course, that's what we want to do for the most part. But from manually searching, sometimes I will just notice a brand or like for the restaurant, I'll notice a restaurant chain that I really, really like, that I personally think, that I just have personally good feelings about. So then I would go and look that one up. And maybe they don't meet strict requirements. Maybe they have a debt to equity ratio that's above 1. But it could just be that they had a particularly large amount of debt in that 1 year, and then their debt to equity ratio is going to go back to being in a position that I would be fine with. So there's sometimes businesses like that, and that's the reason why I don't particularly use stock screeners a lot, because it's very rigid. It just eliminates whatever doesn't meet your criteria. And I guess a workaround for that would just to be be more lenient in the stock screener, and sort of allow for it to move a little bit, allow for slower growth or allow for a higher amount of debt so that you can capture more companies and then you can look through them that way. But generally speaking, I like to manually do it and just look at industries that I know really well and just go through the businesses and compare them against each other and compare them individually and find the ones that are great businesses and offering a high return relative to how much I'm outlaying as an investment. So that's all for this video, just a quick one. I hope you enjoyed this one, and if you did, of course, leave a like and let me know your thoughts down in the comment section below. But I hope you guys have a great day, and I'll see you in the next one.